What's up, Delta Nation? It's your boy Delta here, dropping some serious alpha. Welcome back to Delta Code, where we crack the code of investing. Today's episode, I am going to present you with the infinite money glitch. No, this is not clickbait. This is actually the infinite money glitch. There are 4 steps. I'm going to show you step by step what to do to make infinite money. All right, so this is what it looks like. The infinite money glitch involves selling options. All right, first, to do this strategy, you have to be familiar with options, which I will explain. 2, you have to own at least 100 shares of the company that you will use options to make this income. And then you just rinse and repeat. So, options contract is a contract that gives the buyer of the contract the right to either buy 100 shares or sell 100 shares at a given price up to the expiration date of that contract. That's it. You're not obligated to purchase this, to exercise the contract, but you have the right to. And the person who sold it to you has to abide by the contract. So if I purchase a call options contract, that gives me the right, but not the obligation, to purchase 100 shares of whatever company I bought the contracts of at a certain price. The price is called the strike price. And when you buy or sell a contract, you determine which price or strike price you want to buy or sell this contract at. If the strike price is above the current price, then the option is kind of worthless. It's called out of money. If the strike price is at or below the price of the company right now, that's called in the money. So if the contract is in the money, then it will likely be exercised by the person who purchased the contract because there's money to be made. You can always sell the contract or exercise it. If you exercise the contract, what you're saying is, hey, we made a deal. I get the right to buy these 100 shares at this price. And right now, the price is above the contract price, so I'm in the profit, I'm in the money. I would like those 100 shares now, and here's the money that we agreed upon. The way you can use options to make infinite money is step 1, be long 100 shares. Be long means have the 100 shares of the company. I will show you how I did this with Coinbase with 300 shares. I sold 3 call options. So step 1, own 100 shares. Step 2, sell a call option on those shares. Step 3, let it expire or buy it back if the price drops. And step 4, do this all over again. Okay? So derivatives, options, Greeks, this is all code, and I'm here to decode for you. This is how you do it. Delta Code, we decode finance. Okay, step 1, own 100 shares. In this example, you see above, I have 331 shares of Coinbase. I sold 3 call options for $1,137. Okay, so own 100 shares, step 1. I have 300, so I can do this 3x. So sell the 300 divided by 100 because each call option is for 100 shares. So it means I can sell 3. Okay. Step 3 is I sold them. Now I wait. And each day there's a Greek called theta, which is time decay. Theta eats away at the value of the call option because what you paid for is called time premium. Whoever bought this call option from me paid me for a month long of time that Coinbase might go above $313 a share, where this option will be very valuable at that point. It will be exponentially more. They only committed $1,100 in order to control something like $70,000 of Coinbase value. As you can see, the value of 300 shares is about $65,000. They have the same exposure to 300 shares by only committing $1,100. Should the price go above 310, they can say, hey, Delta, we made a deal. I gave you the money. We have a contract. Now I have to sell those shares, which is called being called away, for $310. I get to keep the $1,100 or $3.79 a share that I sold them for, plus I'm selling at $310, which is much higher than how much I paid. I paid $136 for these shares. Step 4 is just wait. In this example, I have to wait until November 15th, about 2 more weeks, for this option contract to be worthless, or for the person who bought the contract to call these shares, at which point my shares will have appreciated a lot, plus I get the premium. Let's look at the simple math of this. Here is the math. $1,137 I sold the call option for. I paid $45,000 for these shares, these 310 shares, which is about 2.5% of the value I am capturing with this strategy. If I was to do this every month, I would gain extra 30%, or $13,644 within a year. Means each month I can make extra about 2 to 3%, depending on which option contract I choose to sell, netting me about 30% more returns by the end of the year. Now, having 30% gains is phenomenal. Let's look at it differently. Let's say you bought these shares right away, and now when I did at $136, you bought them at the current price. Currently, it's worth $68,000. $1,644 is about 20%, which is still great returns. So if you bought them earlier and you have some shares, you'll obviously have greater returns relative to your initial investment. Let's do some more simple math. If your option gets called, in this case my Coinbase, that is now $215 a share, if it goes over 310 and the person who bought these options from me calls, that means I will have to sell them for $105 more than the shares are worth today. This is 51% more than they're worth now. Am I going to be mad that my shares went up 51% in 1 month? Plus I get the 2.5%, so that's 53.5 or 54% gains in 1 month. No, I will not be mad for making better than most investment managers do in a year. The best, highest paid investment managers barely can make 50% ever. I'll cry. I'll be so sad that I have to sell it for 51% gains. Let us take a moment to appreciate the sad life I will have, because my portfolio had massive gains of 20 to 30% passively. So that there is no downside here if you think about it this way. What is the downside? Downside is Coinbase reports their earnings tomorrow or the next day, and the stock goes up more than 50% in the next 2 weeks, which is possible, but not likely given my forecast. We know how much money to expect from them in this earnings report. It is nothing insane, so the market should not move. We know to expect guidance to be relatively the same as Q3 for Q4, so nothing should be surprising to us. We can do this with other companies, but we feel most comfortable doing this with the company we have most insight in, that we spend most time analyzing. Also, because I have so many shares, this is a no-brainer. Why would I not take 20-30% extra gains per year on all my shares? This is kind of how it works. Step 1, own some shares. Step 2, derivative option stuff that I just explained. And then step 3, profits. Easy mode. How do we choose our options? There is something called Black and Scholes model. Black and Scholes are two fellows who got a Nobel Prize for inventing this mathematical formula of how to price derivatives correctly. Funny fact, story. Edward Thorpe came up with this stuff way before these guys and was upset that they made it public. Edward Thorpe is a hedge fund manager, a mathematician that invented card counting and how to beat the house at roulette. There's an interesting book I highly recommend reading called A Man for All Markets. Interesting story of Edward Thorpe. Here is a link. You go to this website, you plug in the required numbers, and you find out what the option should be priced at. And if it is priced much above this, then for God's sakes, take the free money and sell it. How do I choose which option to buy? Well, I like to keep my Coinbase shares, and I want to sell these option contracts hoping they expire worthless. Like I mentioned before, going up 50% would be amazing, and I'll be happy to sell if that happens. But I think 310 would be not enough for my Coinbase shares because I think they'll be worth $500, $800, or $1,000 in not too distant future. So I want to keep my shares. So if you want to keep the shares of your company, you want to pay attention to delta. Delta is a Greek that you will see when you're dealing with option contracts. Delta tells us how much the value of the contract will move based on $1 move of the stock itself, on the underlying asset. But it's also a shorthand for probability. So if you look at the delta, the market is saying a 0.3 is 30%. So this call option of a 225, for example, in this in here, says that the likelihood of it being exercised, likelihood of the price going above this, is about 39%. Here for the 230, it is 35%. I like to sell call options that have 20% or less probability of being exercised because to me that's free money. Preferably something around 10% or 0.1 delta. That is my sweet spot that I find least risky that my shares will be called away, and most likely that the call option will be just free money. I don't have to deal with tax implications of selling my shares or having to buy them back later despite the premium. So that is what I do. You can choose your own adventure. If you sell a call option with a higher delta, then you can get more of a premium. If I sold a 227 delta, then I could have made about $1,000 per contract, so $3,000 instead of the $1,100 I sold these for. So choose your own adventure. You can find out what level of risk you're willing to tolerate or what price you're willing to sell the shares from. This is for a call option contract that is a month away when I sold it. Right now it's 2 weeks left and the option contract is becoming less and less valuable because there's less time, less probability for that price to get to 310 and for it to be exercised. All right, when do we sell a call option? We sell a call option on a green day. As you can see here, when a lot of the stocks are green, especially the one that we are interested in selling, let's say Tesla, extra green, 3% or more, then the call options will be worth more. People will think it's more likely that that price will happen. If you pay attention to the delta, and if you use the Black and Scholes formula, then you will find often mispriced options that you can sell for much more than their intrinsic value according to the formula. Sell on green days. If you choose to buy back your call option because the price dropped so much, then do it on a red day, obviously. This is very important. There are 4 steps. Own 100 shares. Sell an option that has a low delta if you want to keep your shares or if you want to make more income. use a higher delta, but try to be conservative, especially if you want to keep your shares. You don't want them called away and deal with the tax implications. Most important thing is own the shares. Do not sell call options that are called naked call options if you do not own the shares. When you look into this, the best models and calculators will show you this. When you sell your call option or when you go to enter the order, it will say that your losses are unlimited. I want you to comprehend this. This is very important. If you sell a call option and you don't own the shares, that's called a naked call. If the price goes up so much, you have to buy those shares. Now, how much the price can go up, there is no upper limit. There is no ceiling, right? It's infinite. There are no end numbers. There is a floor. A stock can only go to zero, but how much it can go up is unlimited. So when selling call options, make sure to have the shares. And then if they get called away, oh well, boo-hoo, we made 50% in 1 month. Nobody's going to be sad. You'll look like a genius. You probably should sell if a company goes up 50% in 1 month and get some gains, because often it reverts to the mean, goes back down. As we saw with Chinese stocks, KWEB went up 100%, I think, or 80% in like less than a month. If we sold, then we would have captured those gains, and as it reverted back to the mean, we wouldn't have been hurt with that. I want you to internalize this quote. You can't change the wind, but you can adjust your sail to get to your desired destination. This is very applicable to investing. You cannot control the markets. You cannot control the volatility of stocks, but you can control your portfolio. You can control that you have the shares so that you do not get hurt, but you still get to your desired financial independence destination. I am a long-term holder of Coinbase, so I am happy to hold on to these shares and sell these call options whether they get exercised or not. If they do not get exercised, that is my preferable outcome, is it's just free money and this is an infinite money glitch. If they do get exercised, I was then forced to sell at a much higher price than today, usually 50% greater, so I will not feel bad about this. I also have exit price strategies for my Coinbase shares once they hit certain numbers, let's say 350, 310, 400, 500. I want to sell some of these shares for profits and reinvest in other things because I am right now irresponsibly long Coinbase, and it is such a concentrated portfolio that if Coinbase was to fail, it would be disastrous to my portfolio. This is not a sound risk mitigation strategy, but when you have insights into a company like Coinbase, and that I do, I choose to concentrate my investments in that one company. Both Charlie Munger and Warren Buffett have been quoted as saying that you only get a few good ideas in your lifetime and you only need a handful to make a lot of money. Coinbase is one of my ideas because of my insights in crypto and ability to forecast their earnings very accurately. So I am comfortable investing a large portion of my portfolio. About 90% of my stocks are either Coinbase options or Coinbase shares, and using those shares, I sell more options to make an income. I hope your brain is not melted right now because derivatives can be confusing. I don't want you to shy away from options investing, especially when it comes to this strategy. Buying call options is obviously risky because, as I'm showing you in this infinite money glitch, I am making options that will likely be just money losers to the people who buy them. If you are the person buying the options, most likely, I think 90% of the options expire worthless. So they are a great way to hedge your risk, hedge your downside, make extra income, and or have leverage exposure to the upside should you have some sort of an insight. When I do my Coinbase forecast and I find that my earnings forecast is much greater than what the rest of the market expects, I tend to buy options in Coinbase because I expect the price to be volatile to the upside and want to gain extra exposure. This is not always foolproof. As you've seen, if you followed me for a while, even though my forecast is accurate and Coinbase makes more money than the analysts expected, if their guidance for the next quarter is lower than what the market expected, the stock can go sideways or even down despite having a better than expected earnings report that day. So we cannot control how the market reacts or what kind of guidance the company gives, though I try my best to give you my expert advice on what to expect for Coinbase. I am not always correct. I tend to be more correct than not, but there's always things that I cannot foresee or calculate for Coinbase. Obviously, I don't have any insider information, so I'm doing my best with my knowledge of crypto and forecasting this particular company. Anyways, if you would like to see a step-by-step how to sell a call option, I will show you that now. Step-by-step how I sell a call option on a company like Coinbase. Follow along if you would like to learn this just as an example, or if you plan to use the infinite money glitch strategy yourself. Remember, step one is you have to have at least 100 shares of this company to sell the call option. Naked calls can be disastrous for a portfolio and can lead to unlimited losses. Please do not sell naked calls. Best to sell a call option to a company you have 100 shares or more of and you plan to hold on for a long time. So in this case, it will be free money and you get to benefit from the infinite money glitch. Okay, so for today's example, we are going to look at Coinbase because this is my biggest position and this is where I am using the infinite glitch the most. Right now, it is the 28th of October, so we will look at a month from now call option for November 29th. Right here, we're going to change the strike price to all because we want to see all of them, and we'll click apply. Now, there's a different view of this if you're using Fidelity. I like the old view for now. Okay, so right here we see delta. This is how we decide which option to sell. Option contract. On the right side are puts. We will only look at calls. Let's take out the puts and just do calls to simplify things. Okay. Right here is the strike price. This is the price you are agreeing to sell your Coinbase shares for. So if you look at this dark blue section, these are strike prices that are in the money. Okay, so because the price of Coinbase shares is 216, anything at 216 and less is in the money. Anything close to it, to 20 to 25, it's called near the money. So these are not unlikely to be exercised by this time, and they tend to be very expensive. So for example, a 220, which is only $4 away, costs $20 per share. So this would be, what is that? $2,000 per 100 shares. So the price would actually have to go to 236 for this to be profitable. The $20 you pay for the strike, right, of 220. So this would have to be 240 for it to actually even make you $1. And if we look at the delta, you can think of that as a probability of the price actually getting to that in this time frame. So a 310 probability by, what is this? By November 29 is not very likely, right? So if we take a 310, which we have done before, we can do 315. So we can sell a 310 for about $3, a 305 for $3 to $330. If we want to keep our shares, we want to keep our delta between 0.1 and 0.2. So between 330, no wait, 300 and 20 to 280. So this is the sweet spot where we can get basically free money and use the infinite money glitch. If you sell a call option for 280 strike price, you can make about $5 to $6 a share. If you go on the low end, you can make about $2 to $2.50 a share for your 100 shares. So let's model the 320. At 240, the option will make money. Now again, 240, it is not exercisable because the strike price is 320. But should the price of the Coinbase go up to 240 soon, then the call option will actually have value. And if you think of anything in green here as the inverse, so here this is if I'm selling it, just think of it the other way. At 240, you will have paper losses of about $340. In your portfolio, it would say you lost that much if the Coinbase stock goes up. If the price of Coinbase goes down, you will make this much the next day. Now, arguably, you will make the full amount, which is the $200 here and 20 cents, once the time expires on your option. Theta is 15. So the call option that's $200 basically loses $15 of value every day, going towards, as you can see, time decay, it just goes to zero. There are three tools that you should use when determining which options contract call option to sell. One is a probability calculator right here. Number two is Black and Scholes formula on this website. On this website, 0dha.com. This is the Black and Scholes formula calculator where you put in the price, okay, here, the strike price of the call option when it expires, volatility, which is IV, that is shown right here. Whoops, that is shown right here. Where is the IV? Right here. IV here is 89.79, okay? The strike price here is, the strike price of this one is 320. So let's put in all these numbers together into the options calculator using the Black and Scholes formula and see what should this call option cost so we know whether we're selling it for a good price or not. Okay, so the current price is 216. Okay, 216. Spot is 216. Strike price is 320. Okay. Expiration is, what did we say? November 29. Okay. November 29. November 29. Okay. Volatility we said was 89. Right here, 89.79. And risk-free interest rate is 421. Look it up when you do this because interest rate changes. There is no dividend for Coinbase stock. You can also look that up for the stock that you plan to do this with and click calculate. And according to this Black and Scholes formula, this is the call option premium, 220, 221, okay? For the call option premium and put option, we're not going to deal with that right now. Theta is 15. Okay, so is that how much it costs? Right now, evaluation price, bid is 220, ask is 254. So the person that is trying to buy it is trying to buy it at the theoretical optimal price. Person selling is trying to get more than the price is. The ask is 254. If they sell in the middle, they will still actually get more than the theoretical Black and Scholes formula dictates it should cost. This is why on a day like this, the Coinbase stock went up 5%, is when you want to sell it for above the theoretical price that the Black and Scholes dictates it should be. Okay, so that is how you use the Black and Scholes calculator. Next, is how to look at the probability. This is a fidelity options probability distribution chart. So it will likely go to above 216, 61%. So there's positive momentum. So let's see above 320. It says there's about 0 chance of that happening out here. Out here, when is it? November 29? That is almost done November. We have a probability of 2%. Okay? So by end of November, there is about a 2% chance of it being above $320. It has to be 320 something. 323, I think. Okay, so 2% chance. If you sell this call option at a strike price of 320, the probability of it actually happening is about 2%. 2% means it's unlikely but not impossible. So should this happen, it will happen 2% of the time. Maybe there will be a new ETF. Maybe somebody will decide to buy Bitcoin. Microsoft, for example, has it on their shareholders' voting card whether or not they should have Bitcoin on their balance sheet. If Microsoft adopts MicroStrategy's Bitcoin strategy, buy Bitcoin, hold it, it goes up as the best performing asset that has 50% compound return. And MicroStrategy, fun fact, is a best performing S&P 500 stock, better than Nvidia. Let that sink in. This company's strategy to hold Bitcoin performs better than Nvidia, the most favorite stock of everybody that's talking about. If Microsoft shareholders vote that Microsoft should also hold Bitcoin on their balance sheet, which they will do soon, this could be a very positive catalyst that shoots up the price of Bitcoin, let's say to 100,000. Inevitably, this will positively impact Coinbase, and the price might shoot up past 320 as it is here on this model. So it is not impossible. It is just not very likely. Should that happen, you need to be prepared to have your shares called away, and you should be happy to sell them for 50 or 60% gains in 1 month. If this doesn't happen, which it likely will not, that means 98% of the time you will just make free money. Welcome to the infinite money glitch. Okay, last but not least is technical analysis, also known as TA. When choosing to sell a call option, it is useful to take a look at where the price of the company has been going to and has been at previously to determine whether it is likely to go there. Now, if you know my opinion of technical analysis, it is not reliable, but it is useful when determining entry and exit prices. So if I had Coinbase, for example, and it was down here in the sub 200 range, and I looked at the past performance, knowing what I know about the company, that fundamentally nothing has changed. In fact, it's just becoming a more efficient business that has more products coming online that are making more revenue, I would prefer to sell at a higher price than, let's say, sub 200. I would say, okay, this is seems like the top right here at 280. Maybe when it gets there next time, that's when I'll sell. But when selling a call option, we have to look at the top as the likely. So over here, let's say, what is this? About 280. We don't want to sell it under that if we want to keep our shares. Now, we can also sell near there because people buying these options will look at a chart like this also and say, oh, it has the likelihood of going back to where it has been before. This is proven evidence that this stock can go this high. So this is why I'm buying this call option. If we do not want to have our shares called away, then we want to sell outside of this channel, so above the previous all-time high in the recent months or years. So if we look at all of 2024, the all-time high here was, what is this? About $280, $290. So if we sell a contract that is in the 300s, we can feel comfortable that it is not going to be exercised in the short time frame. Now, if we look at the company's growth over a long time frame, we wouldn't want to sell a contract that is months away or even years away, a leap, for something above 300, because that is likely to happen. And in that case, we don't want to sell it for very cheap, the call option. Here is what I do. I look at this channel and I say, hey, I will not sell a call option that is below 300. So 300, 310, 320 will likely not be exercised because I want to keep my shares. If you want to make more money on your premium, you want to sell something near this line. So 280, 290. Also not likely to happen in the short time frame of a month, but it could happen. It is more likely to happen than above. Also, round numbers are a bias. A round number bias is 300. So maybe the stock will go towards 300, and a lot of people have put sell orders at 300. Maybe they bought at 150, maybe they bought at 100. And they, in their mind, they were like, when this company doubles or triples, which is 300, sell. And for some reason, round numbers attract people. It's easier to decide to sell something at 300 instead of 298 or 301. People will choose the round number. So that's where there will be resistance. And if you look at technical analysis, you can see here that it went near 300 but couldn't quite breach it in the recent years. So the three things to do are use a delta that has a 10% chance of happening if you want to keep your shares, up to a 20% chance for greater premium. If you go above that, if you're okay having your shares called away, great, you're going to make more premium. Number two, use the Black and Scholes calculator to determine what is the fair price of the option you're trying to sell. Don't sell it for less than that, and wait for a green day to sell it, because then you can overcharge and people will pay. And number three is look at the technical analysis I just showed you here to determine what prices you want to sell at your call option, whether you like to gain more premium, something that is near the channel, or as I like to do, something outside of the channel that is not likely to happen for the free money, infinite money glitch. All right, my voice is starting to fade, but I hope you enjoyed the infinite money glitch, the step-by-step tutorial of how to sell a call option, how to analyze which strike price to choose, both using the Black and Scholes theorem, the technical analysis, and looking at the probability calculator on Fidelity. I don't know which platform you use, but if they have a probability calculator, also makes decision making easier. The Fidelity calculator also has a chart that you can move up and down to see your profit or loss potential, so you can extrapolate if this strategy is worth doing for you. Please, whatever you do, do not sell naked calls. Your loss potentials will be unlimited. This is a great strategy to use, the infinite money glitch, selling or writing call options for extra income, passive income on shares of companies you would have held anyways that you have 100 or more shares of. So options can be tricky, can be intimidating, but do not let that stop you. They're actually very simple once you learn the Greeks, once you decode the jargon, which I hope I've done here today. It is a great way to make extra passive income or to hedge your portfolio against losses. Next time, I will also discuss selling and buying puts to protect yourself and make extra income. As always, thank you for tuning in. May the force of compound interest be with you. Peace.
Invested with my boy Delta, we cracking codes. Deep inside the market where the knowledge explodes. Navigating stocks where the rivers flow. Delta forgot more than 11 know. Analyzing trends, no one off the track. Forecasting futures, no looking back. Economy in ruins, but still intact. Building up our wealth, that's a solid fact. Delta at Delta Code, always decoding. Knowledge is a weapon, ever foreboding. Invested with precision, never eroding. Delta's forgotten more than others are holding.